Canada's inflation rate continues to rise. What does this mean for the future of the inflation fight, and what's going to happen to interest rates? This week on the Saskatchewan Real Estate Podcast, we sit down with the financial mechanic, Michael Hernik. A quick note on this episode is that neither of us are economists, and none of this advice should be construed as mortgage advice or investment advice. Please contact the proper professionals for either of those situations. Hope you enjoy the conversation.
This is the Saskatchewan Real Estate Podcast, the show that highlights Saskatchewan real estate. Looking to buy your first house, your next investment property? Subscribe to never miss an episode. Here's your host, Ron Caroni.
Hello and welcome back to the Saskatchewan Real Estate Podcast. I'm your host, Ron Caroni. Here on the podcast, we love to touch on all things Saskatchewan, all things real estate, and also love to do a little bit of economic news as well, because it ties in perfectly so much with what happens to real estate on the downtrend. And the person that I always love to bring on the channel whenever we're talking about interest rates and inflation is my good friend, Michael Hernik, a past guest and probably one of the brightest guys that I've come across in my real estate experience. Mike, the financial mechanic on YouTube, you do a lot of great stuff there. But for anyone who hasn't seen any of our past episodes where we've talked about inflation, Bank of Canada, just give us a brief overview of you and yourself and anything you'd like to introduce about what you do.
Yeah, for sure. Thanks, Ron. I'm humbled by your introduction. I appreciate it always coming on. It's a good opportunity to have this discussion on where we at in the current landscape with the economics. This is really interesting time to really pay attention to what's going on, and I look forward to having that discussion. So.
Yeah, Michael, the financial mechanic, runs a great YouTube channel. So if anyone is ever looking for a little bit more of, I would say, more of an economic perspective, go and check it out. Subscribe. Always really great takes and has a lot more insight than I do. But Michael, you actually reached out to me on this episode. And then as I'd kind of gotten a little bit more thinking about it, it was just perfect timing. Essentially, what we saw in the last inflation report, I believe it was from September, is we went from a lower number of 3.2, correct me if I'm wrong, Michael, and then we went up to a 4%, which was above expectation. And it is a little alarming when you start to think about what the Bank of Canada has been doing and the fact that we've seen a rise in inflation. So let's just start there, Michael. Give us your take on this recent report from the Central Bank of Canada that we're seeing inflation on the move, and give us your take on what we're seeing.
Yeah, absolutely. So exactly. So the inflation rate was in the low 3%. Yeah, it was either 3.2 or 3.3% last month. And you're correct. It is now at 4% in Canada. The US just published their numbers. Their inflation rate is 3.7%. So that's sort of holding from our last month inflation numbers. So you see that the inflation in Canada and the US is very similar. And this is somewhat to be expected because although the US is one of the largest economies in the world, we do a lot of trade with the US and cross-border trade and exports and imports. So you would expect the inflation here, at least in North America, to be similar. What's different from what we chatted about earlier is we talked about this function of interest rates and how it impacts inflation. And what we've seen here in the late part of last year and this year is we hit sort of a peak of 7 to 8% inflation. And the Fed, the central banks all around the world now were tightening interest rates and raising them to bring that inflation number down. And we've talked about that the Fed, the target inflation rate for them, central banks, is 2%. And we're about 2% away from that. So when we hit the peak of 7-8%, interest rates started going up and inflation went down. And this is normally what happens. This is one of the main levers that the central banks use, is to sort of cool that inflation. And it worked, to a certain extent. In the last 2-3 months, inflation, kind of hit that low 3% mark, and everything seemed, good to go. But what has happened in the last 2-3 months since then, about right in the middle of summer, in Canada and in the US, interest rates were paused from rising. In other words, there were no interest rate hikes. And what happened was the inflation rate started going back up. As you said, Canada now has a 4% interest rate, or it's not interest rate, pardon me, inflation rate, and the US has 3.7 when we were at low 3. So in the last 2-3 months, the inflation has almost gone up 1%. So this is concerning to me. And the reason why this is concerning is because what it's showing is that one of two things. Number one, central banks here in Canada and the US may have paused the interest rate hikes too early, or two, that interest rates alone won't be able to cool off inflation. Okay. So this is something that concerns me because the issue I think about at nighttime, is what happens if interest rates alone can't cool off inflation, and then what, right? Then we have this issue where I'm sure we're going to touch on this potential stagflation and so forth. I do want to make one quick comment before we continue, Ron, if you don't mind, is I think it's important to understand what inflation ultimately is. I think a lot of times when you look at business news and stuff like that, you see these concepts in inflation and we're like, okay, we hear this all the time, but what is actual inflation? So we may think that inflation is a rise in prices, which generally that's the end result, is prices at the grocery stores or any kind of goods and services go up. But what folks need to understand is why this happened and why are we here right now? And big part of inflation is actually to do with fiscal and monetary policy. In other words, how much currency is in the system. And what's happening now is throughout the pandemic, the amount of money in the system has increased 30 to 40%. I want you to let that sink in for a second. What that means is that central banks here and all around the world have effectively put into the system 30 to 40% more currency that has ever historically existed. So why, you might say, well, what's the issue with that? Well, I give this example in one of my classes, and I said, if all of us were chasing the same, let's say, desk, and say this desk is very valuable for whatever reason, maybe someone famous owned it, we all want this desk. There's 30, 40, 50 of us in the room. What's going to happen if we're all chasing that same desk? Well, the price of that desk is going to go up because someone is going to say, well, I'll pay a little bit more for that desk, and so on. And you can see the pattern, right? So what's happening is you have more currency chasing the same goods and services. And this is how inflation happens. And this is why we have a rise in prices all around the board. So I just wanted to sort of mention that because a lot of times this is not explained well, and it's important to understand why this is happening. So,
and if I can kind of elaborate on that point too, Michael, I was at a real estate investment meeting where a really well-known local economist came and presented. And his anecdotal view was that as long as governments keep printing lots of money, it does not matter the interest rate central banks will put there. If there's more money being printed out and being pumped into the system, there's still going to be higher rates needed by central banks in order to keep the demand side of this down. But the supply side of the money is super important. And as governments continue to print a lot of this money, the long-term projections of interest rates and the amount of money chasing, those simple items, it becomes very complicated. And I'll kind of throw this to you, Michael, and you've touched on it a little bit, but why is it so concerning that we're starting to see this period where global markets are starting to slow down, oil is on the rise, and interest rates are high? So if we look at inflation, kind of started, I'm guessing off the top of my head, a year and a half ago. So we've kind of been going through, it's not that we've just started our interest rate hike cycle. We're now hitting the 1-year anniversaries of some of these times. So we're not only seeing inflation from last year, but we're seeing increases upon those high inflation years as well. So just expand upon why this is a little alarming right now.
Yeah, I would love to. So this is what keeps me up at nighttime sometimes. This is the nerd in me talking now, Ron. Is you may say, okay, 4% inflation rate. Okay, cool. We're going to hit that 2% target level if we, just let the economy and things just kind of sizzle out and we'll get there. And that's kind of what central banks are saying is let's just kind of see what happens. The issue becomes, okay, can we hit the 2% inflation target? Again, that's the sort of benchmark target that central banks are trying to hit. Yes, we can get there. The problem is that what we've seen in the last 3 months is interest rates alone may not get us there. And if we truly wanted to tackle inflation, we ultimately need like 10% interest rates. That would cool the system down completely.
Right.
But I'm sure
it would also kill the system completely. And it has been surprising. I think why central banks are very uncertain around this time is they believe that these rate hikes would do what they were supposed to do, that they were supposed to bring inflation back to where it was supposed to be. But now we're sitting at, record high interest rates where we're talking 15, 20-year highs in rates. And yet we're still seeing a rise in inflation and a rise in costs. And I think to expand on that alarming part, if the central banks continue to be fairly draconian, it's going to get even more severe on people who are already really struggling. We're starting to see stories coming out that major lenders are no longer doing auto loans because they've just become very bad. The credit delinquencies are on the rise. And this all kind of bleeds into economy, whether we're talking about real estate, but any type of debt financing starts to become very expensive. And I think the most frustrating part about this is as you're trying to communicate with your consumers, you are listening to economists and central banks, and as they're putting out these projections, they're being consistently wrong and off. Even if we take it back all the way to 2020, and now we're into 2023, and at the beginning of this year, there was a projection that at the end of this year, rates are going to start coming down. We're going to start to see this easing, and I think you're already starting to see people on Instagram and people who are projecting that, don't take out any long-term debt because interest rates are going to start coming down. Interest rates will come down. Now, that might be the case, but what happens if inflation starts to rear its ugly head again? And in fact, interest rates don't come down, but they become even higher.
That's exactly the problem so let's just assume in a perfect world that interest rates were to come down in the near future. Okay. That will absolutely increase inflation. It 100% will. We are in the opposite situation right now where inflation in the central bank's eyes is too high. And we are all feeling the pain of the inflation at the grocery store, at the pumps and so forth. So we aren't where we need to be yet when it comes to our target inflation rate. To build on what I was talking about earlier, the thing that also concerns me is that we have mixed data in the economy, and from one end, you can build a thesis saying, well, the economy is strong. We're bringing in jobs, and unemployment is low. But from another perspective, you say, well, we have a problem. We have high inflation and the costs of everything are going up. We have an affordability crisis. We have a housing shortage. We have, the cost for housing with respect to rents all going up and on and on and on. When you actually look at the data closer, for instance, Canada brought in, I believe, 20,000 jobs in their last report. When you actually dig into the numbers, most of those jobs were part-time jobs who were being picked up by existing Canadians. They were not new individuals taking these jobs. So what does that tell you? There was really not 20,000 new jobs. But when you see that, you say, oh, the economy is growing. So we have a lot of mixed data, and it's a really interesting time because central banks are in this predicament of, do we raise the rates another 0.25%? Do we not? If we do, what happens to inflation? Here's the risk, Ron, is if the central banks pause raising interest rates again, let's say here coming up in November, and inflation starts going up, we might have missed the boat on tackling inflation. And what I mean by that is we already have 2-3 months of data that supports that pausing the interest rate hikes almost had inflation go up by 1%, which is huge. So what that tells you is that central banks, if they want to get to that 2% mark, have to raise interest rates. They have to. The question is, can the system take higher interest rates? And I don't think it can. I don't think that the system can sort of handle this. It's just there's too much debt in the market, and from all levels of business, personal, government, all across the board. And on the mortgage side, Ron, I'm sure you've looked into some of these stats too. Almost 20% of mortgages are going to renew next year that were at historically low rates, and then another 20% the year after. So all of these mortgage holders are going to be renewing into potentially 3x, 3 times the interest rates, which is absolutely going to have an impact on housing. So it's an interesting time. And so we'll kind of have to keep an eye on what will happen over the next several months here.
Absolutely. And I think, and just to put a small caveat that the 3x sounds very scary. Oftentimes it doesn't 3x your payment, but there is payment shock store for people who, didn't buy their house in 2008 and have rode the wave down and are riding the wave up. So I'd like to play a thought experiment with you here, Mike. Let's say if we look at what's on the horizon. So I'll give you 1 or 2 options. Maybe I'll think of a third as we're kind of sitting here. But let's just say that if we're looking at a supply and demand scale, that a large part of inflation is caused by a lack of stuff. So in your example, that there's only one desk. Well, in a scenario that say, what if the economy got a lot more efficient? In America and Canada, if we looked at globally, if oil markets started to produce more, energy became cheaper, if we started to build more houses, if regulation was less, if we could find a way to put ourselves where a supply side got fixed, would that ease on itself? And do governments need to be a part of that while also doing some inflationary spending to get there?
Yes, the short answer is yes. If we fix supply, inflation will decrease. And the reason for that is, let's take commodities, for instance. There's been a historical underinvestment in all commodities, oil, gas, agriculture, all types of mining, mineral exploration. There's just been a significant underinvestment in this. And this is also partially why you see commodity prices going up. So yes, if governments were to sort of invest in the supply side of things, it will take time. It won't be fixed overnight, but it will absolutely help cause inflation. The issue, Ron, is governments are very reactionary as opposed to sort of being proactive. So what will likely happen, again, we'll see what happens, but this playbook has happened before during the pandemic and in the Great Recession in 2008 and 9, is if we do see a complete, lack of confidence and a collapse in the economy, I would put money on the table to say governments are going to print more money again, which is again inflationary in itself.
And so this is thought experiment number 2, that if we don't fix the supply side of increasing the amount of goods and services that people can buy for the currency units that we currently have. So if we play out the thought experiment of we continue to print money, interest rates continue to get higher. If you don't have access to the currency units, if you're a regular person who is not able to tap into lending markets, you might start getting very pinched by this. And so, yes, I think you're right that eventually if that thought plays out completely, there's going to be so much political unrest from people who are going bankrupt, who can't make their payments, that it's going to be politically untenable to continue to raise rates. And what happens after that? Is there a thought that if we get to a place in the economy where do we just have to continue to print more and more money? Or is there a judgment day where we say, no more printing, a reset of the currency? And this is all hypothetical, and a reminder, I'll include it as the intro on this, Mike. We are not economists. We are 2 average dudes who like finance, but just play it out that if we got to a place where we had to keep printing and printing and printing, what happens?
Well, it's inflationary by nature. So if we have a lack of confidence and a collapse in the economy, if fiscal policy is such that we print more and more money, we potentially could run into a hyperinflationary environment. Now, although hyperinflation is on the table, I think it's somewhat unlikely, but it is still a possibility. I'll tell you, Ron, what I think is more likely to sort of materialize is something called stagflation. And you and I have talked off air about this. So stagflation is a term that you may have heard, but basically it's where inflation is rising, but economic growth is declining. It's falling. So, and I would almost argue we are in a stagflation economy right now, because some of the economic data that folks believe to be strong economic data, in fact, is not strong economic data. You still have businesses that are struggling after the pandemic, and all other sorts of types of data. And I mentioned this with the job numbers. There's lots of things we can look into to help support that thesis. But so stagflation is a tricky one, because if inflation is going up, but there is no growth in the economy, what do you do? And this is something that central banks are extremely scared of. So, because it's very difficult to tackle that. You can't raise interest rates. The economy is decreasing. Usually you want to lower interest rates to stimulate spending, which will then increase inflation again. So, yeah, I think central banks all around the world are slowly realizing they're backed into a corner, and they have to be very careful with what they do. I just hope that they don't pause raising interest rates to a point where inflation creeps up too quickly, and then we might have an issue where those interest rates are going to have to be increased quickly again, and it'll cause economic damage much quicker. In other words, the landing will not be soft.
All right, now that we've completely depressed everyone with current outlook, I did want to kind of end this podcast on a really positive note, because I think interest rates are very scary. The current climate of the world, as we're recording, it's October 13th, war between the Gaza Strip and Israel. These are all things that are incredibly negative. And I think what I'd love people to take away from this podcast is that Saskatchewan is one of these perfectly positioned provinces to do quite well over a really negative time. And I think you can appreciate and elaborate on this a little bit more, Mike. When you look at the type of economy that Saskatchewan has, it's very much a commodity-based economy that is very stable, built on things that no matter what, people need to buy. And I think that's an important factor, that if you move into a world where, hey, we need to cut the Netflix account, we need to stop spending on things that are not necessary. The things we produce and the jobs that are tied here are incredibly necessary. If you look at like agriculture, if you look at oil and gas, uranium, these are all things that we have here, and it's just going to absolutely boost our economy in a very weird way. So let's just end it off with talking about Saskatchewan as a whole a little bit, and why ultimately this is going to be really positive for things like Saskatchewan real estate as a tertiary effect of being a commodity-based economy.
Yeah, for sure. I appreciate you bringing it back. I think it's important to precurse our previous discussion that this is a macro level of where we are sort of on a global level. Now, when we look at sort of more of a microeconomic level, like you said in Saskatchewan, I think I'm very bullish in Saskatchewan. Saskatchewan's very well positioned. We produce some of the most needed commodities in the world. Like if you take uranium, for instance, uranium has almost basically doubled in price over the last couple of years. And we have a lot of uranium in Saskatchewan. This is very good. Same thing with other commodities. You have BHP investing billions in Jansen, and expanding and growing there. It's a very exciting time to be in Saskatchewan. So yes, I'm very, very bullish on Saskatchewan. And I want to sort of remind everyone that the previous discussion is more from a macro level, and it's important to understand the macros. And I'll say one more thing, Ron, if that's okay, is basically, regardless of what happens over the next few years, even if we see a complete, economic collapse and a recession, bad times bring good times and good times bring bad times. So when there's fear in the market, it's time to be greedy. And when there's a lot of greed in the market, it's time to be fearful. I think that's one of Warren Buffett's quotes, and it's so true. So again, it's also a time to be optimistic, especially now with the rise of AI and what it's doing and all these different things that are happening and coinciding with what we just discussed. It's a time to be optimistic and look at opportunities and it's more so to be educated on what could happen and what the probabilities are of this discussion, and I think that's what our goal here is to do, Ron. So
we don't want to terrify people, but I think the
absolutely
idea
not.
of we get that question, and I'm sure you get a lot too, Mike, of what's happening with interest rates. When are we going to see these things play out in the economy? And I think when you start to pay attention to some of these indicators, it helps you understand exactly what we're seeing. And I think the real key is to try not to exactly predict what will happen, but keep yourself flexible enough that you can take advantage of either or scenario, and neither is going to sink your ship, and you're going to get safely to the other side. If I can lastly just say one more point about Saskatchewan, the incredible or the really exciting thing about all of this investment that's taking place in Saskatchewan, the Jansen mine, the uranium, the lithium actually that's starting to being produced here in the province. The wonderful thing about a growing economy is that even after our commodity cycle goes down or the commodity prices lessen from where they are, is that infrastructure is there. And then you've got these consistent, steady jobs that don't go away. And it's really just this amazing building block. And I think it also gives you this wonderful long-term projection for the province. So I think it's just a wonderful time to be in the province. And as bad as things are kind of globally, nationally, there are always those kind of little opportunities that you can look for. And I think that even on a micro scale goes down to, where can I take advantage of potash mining? Which community would I look at if I were in Saskatchewan? And so, I think a really round discussion here, Michael. Anything else to leave us off with before we end it?
No, I think the only maybe one quick point, I guess, on the commodity side is, even though we have inflation here, one of the positive byproducts of inflation is actually commodities, because most commodities do well in an inflationary environment, because that's partially why inflation is there. So this is what I mentioned earlier, is when you see uranium and other commodities all increasing in price, it's because we have inflation, and that in itself will yield wealth for any sort of jurisdiction that has commodities, and Saskatchewan as well positioned for that.
Which is exactly why everyone who's watching this video or listening on Apple or Spotify should go to Michael's channel, The Financial Mechanic, as Michael does a really great job of touching on different news in relation to commodities that are happening, very specifically uranium. I think you have kind of a love affair there, Mike, with uranium, and I always appreciate your take on that. But if anyone wanted to get in touch with you on the YouTube side, Michael, just tell us where we go.
Yeah, for sure. It's just The Financial Mechanic. That's the YouTube channel. And I'd love to get your support and appreciate anyone, and if you guys have questions for me, feel free to reach out as well. I'm at any time. So
wonderful. Thanks so much for your time, Michael. Always appreciated. I'm sure we're going to do this again. So thanks very much.
Thanks, Ron. Appreciate it.
Thanks for checking out this episode of the Saskatchewan Real Estate Podcast. I hope you found some value here. And if you did, make sure to hit the like button to show YouTube or Apple and Spotify that you enjoy this podcast, and it'll show you more episodes just like this. And to make sure it does so, you can also hit the subscribe button and also notify to know when new episodes arrive. If you're looking for a mortgage in Saskatchewan or looking for a little help understanding interest rates, if you have a renewal coming up, I can absolutely help you out with that. I'm a licensed mortgage broker who can help you with a purchase, renewal, or refinance. Until next week, I'm Ron Caroni, your Saskatchewan mortgage professional. Bye for now.